Let me ask you a math question. Two investors both start with $500,000, both average rate of return of 7% a year over 20 years of retirement. Investor A gets the good years first, strong returns early, weaker returns later. Investor B gets the bad years first, steep losses early, strong recovery later. Same average return, same time horizon, same starting balance, same ending balance, right? Wrong. By a margin of hundreds of thousands of dollars. That gap has a name. It's called sequence of returns risk, and it's the single most underestimated threat to your retirement income. Today, I'm going to show you exactly how it works and exactly how to protect against it. Welcome, welcome, welcome. You're listening to The Income Standard, where retirement income is designed, not guessed. I am Tod Long, and this is the show for people who are done accumulating and ready to start engineering. Let's get into it. Welcome in, folks. I'm going to get right into it today. It's a good subject to talk about. Most people understand that markets go up and down. What most people don't understand is that in retirement, the order of those ups and downs matters more than the average. During accumulation, when you're building your nest egg, sequence doesn't matter much, really. If your portfolio drops 30% in year 5 and recovers by year 10, you're back on track. The math is symmetrical. Retirement breaks that symmetry. The moment you start withdrawing from your portfolio, taking money out every month to live on, a bad sequence early in retirement causes damage that average returns cannot repair. And here's why. When you sell assets in a down market to fund living expenses, you lock in losses permanently. Those shares are gone. They can't participate in the recovery. So when the market bounces back, it's bouncing back on a smaller base, a base permanently impaired by the shares you sold at the bottom. The technical term for this is sequence of returns risk. The plain language version is your retirement is the most fragile in the first 5 years. A significant market loss in that window can permanently alter your retirement outcome, even if the market eventually fully recovers. So let's go back to our two investors. Both start with $500,000 and need $30,000 a year to live on. Both average roughly about 7% annually over 20 years. Investor A gets plus 20%, plus 18%, and plus 15% in years 1 through 3. Their portfolio grows early, and withdrawals come out of a healthy, expanding base. At year 20, they have approximately $810,000 in their account. Investor B gets negative 22%, negative 15%, and negative 8% in years 1 through 3. Then the same strong recovery that follows. Same average. But those withdrawals in the early down years came out of a collapsing portfolio. By year 20, Investor B has approximately $270,000 in his account. Same average return, same withdrawal rate, $540,000 difference in outcomes. The only variable was the order. That's not bad luck. That's a structural risk. And it's one that has a structural solution. Here's the key insights. Sequence of returns risk is not a market problem. It's a withdrawal problem. Investor A and Investor B were exposed to identical market conditions. What separated them was whether portfolio withdrawals were hitting the portfolio at the wrong moment during the losses. Which means the fix is not about picking better investments, finding a smarter allocation, or timing the market. The fix is structural. It's about ensuring that when the market drops in the early years of retirement, and we both know At some point, it will drop. You're not forced to sell into that decline. The mechanism that makes that possible is a guaranteed income floor. If your non-negotiable monthly expenses are covered by income sources that don't come from your portfolio, Social Security, pension income, annuity income, then a market downturn in year 2 of your retirement doesn't force you to sell anything. Your guaranteed income keeps arriving. Your bills keep getting paid. Your portfolio sits intact, waiting for the recovery. Closed income floor doesn't just protect your lifestyle, it protects the portfolio's ability to recover. That's the sequence of returns buffer, not a defensive investment strategy, a guaranteed income layer that eliminates the need to touch the portfolio when it's most vulnerable. Most people think about portfolio protection in terms of asset allocation, more bonds, less risk, smoother ride. That's not wrong, but it doesn't solve the withdrawal problem. A 40% bond allocation still requires withdrawals from a portfolio that has declined. A guaranteed income floor eliminates the withdrawal from the declined portfolio entirely. Those are fundamentally different mechanisms, and only one of them addresses the root cause. I want to put a specific boundary on when this risk is most dangerous. Sequence of returns risk doesn't threaten your retirement equally across all 30 years. It is concentrated in a specific window, roughly the first 5 years after you retire. Here's why that window is different from every other year that follows. When you first retire, your portfolio is at its maximum size. And your draw rate, that percentage you're actually pulling annually, is also at its highest relative to that balance because you haven't yet had decades of income compounding to buffer it. A 25% market drop in year 2 of retirement is not the same as a 25% market drop in year 15. In year 15, your guaranteed income has been working for 15 years. You may have optimized Social Security. You may have an annuity generating income. Your portfolio withdrawal rate may have reduced. In year 2, the floor may not be fully closed yet. The portfolio is still the primary income vehicle. And the damage from selling at a 25% loss compounds forward across the entire remaining retirement. I've had this conversation with people who retired in late 2007. Good plans, diversified portfolios, reasonable withdrawal rates. And then 2008 happened, right in their critical window. Some of them recovered. Some of them went back to work. The difference almost universally was whether their income floor was closed before the drop hit. The sequence risk window is open from the day you retire. The time to close the floor is before you step through that door, not after the market reminds you it was open. If you're within 5 years of retirement and you don't have a clear answer to what happens to your income if the market drops 30% in your first year, that's not theoretical risk. That's your window, and it's open right now. Every retirement income plan built to the income standard includes an explicit sequence of returns buffer, a protected income layer that eliminates the need to sell equity assets during down markets in the critical early retirement window. What that buffer looks like depends on the individual situation. For some people, it's Social Security optimization. That's delaying to maximize the guaranteed benefits so the portfolio draws less in the early years. For some, it's a fixed index annuity that generates guaranteed lifetime income without market exposure. For some, it's a combination, Social Security providing the foundation and annuity closing the gap between Social Security and that non-negotiable expense. The specific tool matters less than the principle. You should never be forced to sell equity assets to fund living expenses in a down market during the first 5 years of retirement. If your plan doesn't have an explicit answer to what happens when the market drops 40% in year 2 of your retirement, you don't have a plan. You have exposure. We're at the halfway point, and this is a good time to pause. We've established what sequence of returns risk is and why the order of your return matters more than the average. That's the concept. Now I want you to see what it looks like with your actual numbers. Go to theincomestandard.com and find the sequence risk calculator on the resources page. You enter your portfolio balance, your annual withdrawal, your expected average return, and what a bad first year looks like. A 20% drop, a 25% drop, whatever you want to stress test. The calculator shows you 3 scenarios side by side. Your portfolio balance at 20 years with no floor, with a partial floor, and with a closed income floor. The difference between those 3 numbers is the dollar value of sequence protection. Not theoretical, your numbers. For most people running this for the first time, the gap between the no floor scenario and the closed floor scenario is the single most important number they've ever put into a calculator. If you're driving, come back to it. But if you have 4 minutes right now, stop and run it. Theincomestandard.com, resources, sequence risk calculator. I'll be here when you get back. Let me show you what a sequence of returns buffer looks like in a real planning scenario. Obviously, names have been changed to protect the privacy. Robert is 63 years old. He has $900,000 in a traditional IRA and $120,000 in a Roth. His Social Security at 66 would be around $32,000 a year. His non-negotiable expenses is roughly about $54,000 a year. He wants to retire at 65, and he's worried because he left his previous company in 2008, watched the market collapse, and saw colleagues who stayed retired get permanently impaired in the first 2 years. Robert's Monte Carlo projections looked good, 91% success probability to age 90. His advisor called it solid. But when we mapped the income architecture, here's what we found. So Robert's plan was to retire at 65 and take Social Security immediately, which is $32,000 a year. His non-negotiable expenses is $54,000 a year. His gap for this right here is $22,000 a year, or roughly $1,800 a month. It's exactly $1,833 a month, which was going to be pulled from the portfolio every year starting the day 1 of his retirement. That's a 2.1% annual portfolio withdrawal just to cover non-negotiables before a single dollar of discretionary spending happens. Now, let's look at the stress test. Market drops 30% in year 2. Robert's $900,000 IRA is now $630,000. He still needs that $1,833 a month from the portfolio, but now he's pulling it from a portfolio that's $270,000 smaller, and he's selling shares at their lowest point. The 91% Monte Carlo probability didn't show Robert that scenario in dollar terms. It averaged it away. But Robert had seen it happen in real life to real people, and he was right to be concerned. Here's what he did instead. Robert delays Social Security to 68 years old, increasing his guaranteed benefit to $38,400 a year, which is roughly $6,400 more annually than filing at 66. To bridge the gap between 65 and 68, we use $72,000 from his Roth, 3 years of bridge income, tax-free, no sequence damage to the IRA. At 68, Social Security at $38,400 covers 71% of his non-negotiable floor. The remaining 29%, that $15,600 a year, gets closed with a fixed index annuity funded by $180,000 repositioned from the IRA. That annuity generates $1,300 a month for life, closing in the floor completely. The result? Robert's remaining $720,000 portfolio is completely insulated from the non-negotiable floor. If the market drops 40% in year 2, and it might, Robert sells nothing. His guaranteed income keeps arriving. His floor holds. His portfolio recovers on his full remaining base. He didn't eliminate market risk. He eliminated the forced selling that turns market volatility into permanent retirement impairment. If Robert's worry sounds familiar, if you've been watching Monte Carlo percentages and wondering what they actually mean for your first bad year, the specific number that matters isn't 91%. It's how much of your monthly floor is guaranteed and how much depends on the market cooperating. Those are different questions, and only one of them protects you. Now, let me show you what Robert's original plan costs if he retires without closing the floor. Year 1, markets cooperate. Robert pulls $1,833 a month from the portfolio. The IRA grows slightly despite withdrawals. Everything feels fine. Year 2, the market drops 28% over 9 months. Not a crash, just a significant correction. Robert's $900,000 IRA is now around $625,000 after withdrawals. He still needs that $1,833 a month. He pulls it from a portfolio that is down almost a third. He's now sold roughly $22,000 worth of assets at their lowest valuation of his retirement. Year 3, the market begins recovering, but Robert's recovery base is permanently smaller. The shares he sold at the bottom are gone. The recovery happening in the market is not fully happening in his account. Year 5, Robert has a health event, knee replacement, 3 months of recovery. Out-of-pocket cost, $18,000. That's an unplanned withdrawal on top of the $1,833 monthly floor gap, again, from a portfolio that never healed from year 2. By year 10, Robert's portfolio has recovered on paper, but its effective balance, adjusted for the permanent impairment of early forced selling, is roughly $140,000 lower than the same portfolio would be if the floor had been closed before retirement. $180,000 repositioned into guaranteed income in year 1? Social Security delayed to 68? Floor closed. None of that chain of events happens. Robert didn't need to avoid the 2008 style drop. He just needed to be structured so the drop couldn't force him to sell into it. The sequence risk window closes on its own, eventually. The question is whether your floor is closed before it opens. If you've been thinking about your own sequence exposure while I've been talking, if you're within 5 years of retirement and haven't mapped exactly how much of your monthly floor is guaranteed, that's the number that needs to be on your paper before anything else. Sequence of returns risk is one of the most measurable risks in retirement income planning. It's not a mystery. The window is known. The mechanism is known. And the solution? A guaranteed income floor that eliminates forced selling is available to most people who are within 5 years of retirement. What's not available is the specific measurement of your exposure. How much of your floor is guaranteed today? How much depends on portfolio withdrawals? What the dollar impact of a 25% early retirement drop would be on your specific situation. The Income Standard Review includes a sequence exposure analysis. We model your current income architecture against a stress scenario and show you exactly where your floor holds and where it doesn't, with your numbers. This isn't a theoretical exercise for people who like financial stress tests. It's for people who remember 2008, who are close to the retirement window, and who want to know specifically, before they step through it, whether their structure will hold. If that's you, the review is the right next step. Schedule your review at theincomestandard.com. No cost, no sales pitch, just measurement. That is the income standard for this week, folks. If this episode gave you a framework you didn't have before, share it with someone who actually needs it. Forward it to a friend who's 5 years from retirement and still thinking in terms of balance sheets instead of income architecture. And if you found yourself thinking about your own income floor while listening, like what's guaranteed, what's not, and what that gap might be, that's the signal. That's when this review makes sense. The review is waiting for you at theincomestandard.com. Again, that is theincomestandard.com. There's no cost, there's no pitch, just measurement. I'm Tod Long. We'll talk to you next week.